We'll continue with economic growth and output gap. So today we're going into the trend growth rate. When we talk about the trend growth rate, it's simply talking about the productive potential of the economy, what the economy can achieve over a period of time. But when it comes to productive potential of an economy, it's likely to fluctuate. That means it is not going to be stable over time. So that means whatever we talk about in what we can achieve over time, it's either it increases or reduces. So one of the reasons why we have fluctuation are what we want to look into now. So there's fluctuation based on the fact that the economy cannot remain constant for a long period of time within a year. There are different things that would happen. So those things that could cause fluctuation are the demand shock and the supply shock. So these things are external. They are beyond the control of anyone. So causes of fluctuation, are you there? Causes of fluctuation is short-run growth rates. The reason for fluctuation are classified into two: demand side shock and supply side shock. So we're going to start with demand side shock. We call it demand side shock because it affects aggregate demand within the economy. And when we talk about aggregate demand, we're talking about the total demand within the economy. So examples of demand side shock are: one, the housing market bubbles, which may burst. So we know what market bubble is already based on speculation. So here they said a housing market this occurs when house prices rises too high a level and suddenly there is a collapse in demand for housing and a sharp fall in house prices. This reduces consumer confidence, leading to less consumer spending and fewer new houses being built, which affects output and employment. So one of the reasons why we could have demand side shock is a market bubble. Making an example of a housing market. So there is an increasing demand for housing. As a result of that, there's a sharp rise in the price of houses. And suddenly, the demand starts falling. And as soon as the demand falls, the price would start to drop. The bubble burst. So that makes house owners to start losing their confidence within the economy. As a result of that, demand reduces, aggregate demand will start falling within the economy. And that will affect both output and employment. How will it affect output? It affects output because people do not want to buy anymore. The demand for houses has stopped. So new houses will not be built. And if new houses are not built, it means the demand for workers to build new houses will not be needed. So that reduces employment.
Okay.
Do you understand how it reduces now?
Yes.
Okay. So that's the first one. Then the second one, the stock markets, which may crash. While the stock market prices are too high, a stock market crash reduces the wealth of individuals who are then likely to reduce their spending and save more to build their wealth. This reduces aggregate demand and causing recession. So let's talk about the stock market. For the stock market, we have speculation too. We have the bull and the bear. The bull are individuals who want to buy shares now in the hope that they have the optimistic hope that they are optimistic about the future, that prices will rise over time and they will start selling. And for the bear, they want to sell now so that they don't lose. So these things also may make the stock market to crash. So as soon as the stock market crashes, the wealth of the people will drop. And if wealth drops, they will start thinking about saving more to rebuild their wealth because the market has crashed. Where their wealth is crashing. That's a negative wealth effect. We call it negative wealth effect. So as soon as this happens, people will start losing confidence. So they would rather want to save, to start rebuilding their wealth. And in the course of rebuilding their wealth, aggregate demand is expected to fall. And if aggregate demand falls, it will cause recession. I think the second point is clear. We are still on demand shock, which might affect the trend growth or output gap within the economy. The third one, the central bank. For the central bank, we have this. The central bank may sharply raise interest rates to combat inflation. This reduces consumer spending on durables and investment spending on the economy, which sending the economy into recession. Maybe there's inflation. Maybe demand within the economy is increasing. And there's always going to be inflationary target. So the central bank has its inflationary target. So if inflation continues to rise over time, the central bank might come up with interest rates, increasing the interest rate. As soon as the central bank comes up with increasing the interest rate, this reduces consumer spending on durables. And if consumer spending on durable reduces, investment is expected to fall. So this will bring back the economy into recession again. Do you get the point here? The next one, the government may sharply raise taxes or cut government spending. Raising taxes or cutting government spending is a contractionary fiscal policy. We call it contractionary fiscal policy. So if this happens, it will reduce aggregate demand. And if aggregate demand falls, it affects recession also. So we are still talking about demand side shocks. All these I'm saying will affect aggregate demand. I think the point is clear. The next one, the world economy may go into recession, hitting an economy's export sharply and so sending the economy into a recession too. We talked about reliance on exportation. If countries rely on exportation, there is world recession in the economy, or world economic recession. So this will affect countries that do export. And if countries are unable to do more export, if they are unable to sell what they are used to selling, it will put them back into recession because aggregate demand would fall also. I think the point is clear. And the last one, which is demand side shock, is a sharp rise in the value of currency. When we talk about the sharp rise in the value of currency, we're talking about currency appreciation. So if the currency appreciates, if the Libyan currency appreciates over the dollar, it simply means the Libyans will do more of imports because export becomes expensive for foreign customers. So those who buy from Libya will stop buying because Libya will be less internationally competitive. And on the other side, there will be more withdrawals in the Libyan economy because Libyans will be able to buy more on imported goods. And that would also lead to a fall in aggregate demand, and which will subsequently lead to what? Economic recession. Put the economy into recession. Demand side shock, clear? Demand side shock affects aggregate demand within the economy. And all these factors I mentioned here are reasons why we could have a low aggregate demand. I think it's clear. Then that takes us to supply shock. For supply shock, we're talking about factors that affect aggregate supply within the economy. When we talk about aggregate supply, we're talking about the total supply within the economy. So the first one said, a large rise in the world commodity prices could both raise the price level in an economy and lead to a rise in import values if demand for the economy for the commodity is priced inelastic. The rise in import cost will reduce aggregate supply, leading to lower output. If the price of commodity increases, world commodity increases, and if those commodities are priced inelastic, it means firms will not have any other choice than to buy. That increases the cost of importation. And if it increases the cost of importation, it brings about a fall in aggregate supply, which will lead to what? A lower output. Clear?
Yeah.
An increase in trade union activity could see large wage increases that will raise the price level substantially and reduce aggregate supply, leading to recession. Another reason why we could have a supply side shock, is the power of the trade union. The trade union, if they are so powerful, they can influence government decision. In as much as they can influence government decision, they will be able to influence firms' decision. So if they are able to negotiate for better pay or conducive working environment for their members, it means the cost for firms would rise. And if the cost for firms rises, it will reduce aggregate supply and lead to recession again. I think it's clear.
Yeah.
So the examples given above all okay. So all the above mentioned are negative shocks. So all we've talked about are negative shocks, but they can also be a positive shock. So, but note that any negative shock that we talked about will bring about a leftward shift in the aggregate demand curve and a leftward shift in the short-run aggregate supply. I think it's clear.
Yeah.
And as a result of that, it will affect the real GDP of the economy. Any question about that?
What do they mean when they say if an economy is a net importer of oil and other commodities, the equilibrium level of real GDP will increase?
Did you say what?
They say if an economy is a
Okay.
net importer of oil and other commodities, the equilibrium level of real GDP will increase.
If there's price inelastic, right? If the importation is price inelastic, so which if the commodity is price inelastic, it means the importation value for the country would rise. So that will improve its own GDP. But it will put the country that does the importation, it will put the country into a negative or a worsened balance of payments.
Okay.
If importation is inevitable, we have to buy. Yes or no? So if we are buying, the country selling to us will increase, it will increase its own GDP, but it will affect our own GDP, our own balance of payments. So an increase in the country's GDP
may affect other
will bring about a worsening balance of payment for other country.
Okay.
Is it clear now, please? Great. So that takes us to
Output gap.
Output gap. Okay, yeah, like I need to talk about, okay, I said, okay, however, there could be a positive shock, which will increase the short-term aggregate supply curve. For example, a sharp fall in oil and other commodity prices. This will increase the equivalent level of real GDP. So here, we can have a positive shock, like a fall in the price of oil. A fall in the price of oil represents a fall in the cost of production. And if there's a fall in the cost of production, the real GDP will increase. And if the real GDP increases, it will bring about a positive output gap. I think it's clear. So we'll go to output gap now. Are you there? So we call it output gap because it's the difference between the actual output and the potential output. The actual output and potential output. That is what output gap is. Then we have another name for potential note. There's a note here. Potential output can also be called the trend output or the productive capacity of an economy. So we call it the trend output or the productive potential of the economy. I think the point is clear there. So that takes us to, so I'm just going to explain what output gap. We have negative output gap and positive output gap. Why do we call it negative output gap? We call it negative output gap because the actual output is less than the potential output. That means the economy is operating below the trend level. The trend is the potential. So it is negative because we are below. Do you understand? We are unable to reach our full potential. That is a negative output gap. I think it's clear. Then we have so when there's a negative output gap, it means that there's a spare capacity within the economy or there's a slack. A negative output gap means there's a spare capacity or a slack within the economy. Do you understand?
Yes.
So most of the time we have a negative output gap or a slack in the economy because there's a weak aggregate demand.
Okay.
Do you get it? Any question about that?
No.
Good. So we have, okay. So neither the positive nor non-negative output gap is ideal. So both positive and negative output gap are not something that should occur within the economy. For the short run, yes. But in the long run, it is not ideal for any economy. So here I wrote, neither positive or negative output gap are ideal because a negative output gap represents underutilization of some factors of production. So we are having a negative output gap because there are some unemployed resources. And if there are unemployed resources, it means aggregate demand within the economy would fall because people will not have income as they are supposed to have. So that means we are operating below our trend. Do you understand that? Why for positive output gap? It represents overutilization of the production, of some factors of production. So you are putting strain, you're straining, you are using more than what you are supposed to use. That's a positive output gap. And that will bring about increasing aggregate demand, which will lead to inflation. Do you get the point here? So here I wrote a positive output gap represents overutilization of some factors of production. So for negative output gap, it may result into deflation. Negative output gap will lead to deflation because people do not have income. So price level will continue to drop. And deflation will lead to recession. A positive output gap may result into demand pull and cost push inflation. So you see, that's why both of them are not ideal. Demand pull inflation will lead to recession. Cost push inflation will lead to recession. Deflation will lead to recession. So neither both are ideal for a given economy. So the economy should operate on the trend. That is what the point is. Any question about that?
No.
So that takes us to positive output gap. Are you there?
Yeah.
Okay. So we're going to a positive, like I told you earlier, we have output gap, which can be either positive or negative. We call it a positive output gap because the economy is operating above the trend level or the trend level real GDP. And we call it a negative output gap because your economy is operating below the trend level. I think that point is clear. So now, since output gap simply means that the economy is above the trend level, then we can represent the graph through this way. This is the graphical representation of the trend level. So here we are operating above. This is the short-term aggregate supply curve. This is equilibrium, but the economy is here. So the point is that when the economy, we are operating at OY2, further than LRAS. The long-run aggregate supply is here. The long-run aggregate supply, this is our long-run aggregate supply. This is where the economy is, but the economy is operating above it. So there's a positive output gap here. This is a positive output gap. This is what we call positive output gap. I think it's clear. So for positive output gap, here I wrote, the graph above indicates that the long-run equilibrium output of the economy is at 0y1. That's where the long-run equilibrium output is. But, however, the short-run equilibrium is higher. The short-run equilibrium is at 0y2. So that means we are operating more than our capacity. So that is a positive output gap. Do you understand what positive output gap is here? So this situation is a situation that is not ideal according to what we say, because a positive output gap will bring about cost push inflation and demand pull inflation, and both of them will lead to recession. So that means we have to solve this problem of positive output gap. So how do we solve it? This situation will be fueled either through long-run economic growth, which will move the long-run aggregate supply curve towards 0y2. So we have to solve this issue. So to solve it, we have to move our long-run aggregate supply curve towards the short-run aggregate supply curve, towards the equilibrium. So that means we're going to talk about LRAS1 going to LRAS2. So that's the first situation. We are talking about filling the positive output gap. To fill it, we have to shift, the long-run aggregate supply curve has to shift towards equilibrium at 0y2. That's the first point. Or recession, which will shift the aggregate demand downwards. Or we have recession. And if we have recession, it will mean that the AD curve will shift leftward from Y2 to Y1. Okay. Do you get it or not?
Yeah, I get it.
With recession, aggregate demand is expected to fall. So if aggregate demand falls, it affects the AD curve. So the AD curve will shift leftward towards the LRAS.
Okay.
So is either we move the LRAS curve to the right, or we shift the AD curve to the left. Okay. That would fill up the positive output gap. I think the point is clear.
Yes.
Okay. So that is about positive output gap. Any question about positive output gap?
No.
Okay. So for the central bank now, what can the central bank do to ensure that aggregate demand reduces? The central bank may raise the interest rates to reduce aggregate demand in order to reduce demand pull inflation. So I said earlier that with positive output gap, it may bring about demand pull inflation. So if government wants to solve, because the central bank has an inflationary target. So if the central bank of a country, if the central bank of Libya understands that it is unable to anchor the inflation. So it means it has to increase its interest rate. So increasing the interest rate means the cost for borrowing would increase. And if the cost for borrowing increases, consumption would fall. Demand pull inflation would reduce. But you get the point here? On the other hand, as soon as the central bank does that, if it doesn't change the positive output gap, then workers would have to ask for a wage negotiation to meet up with the increasing demand, with the increasing inflation rate. Get the point here. If the central bank tries to solve the problem and it's unable to be solved, it means inflation continues to rise over time, yes or no? So if inflation continues to rise, workers will demand for an increase in wage. We call it indexation. We talked about it previously. Okay. So if workers demand for increase in wages, this will increase the cost of production for firms. That will lead to cost push inflation. And if there's cost push inflation, it means that this will increase the cost in the economy, shifting the supply curve upward. So the supply curve will shift upward from SRAS to LRAS1. Do you get it now? So If that happens, then the economy will go back to its trend. Get the point here. Using demand pull inflation, if it doesn't solve the problem, then workers will demand for more wage to meet up with or to maintain their level of consumption. So to maintain their level of consumption, they have to increase, the employers have to increase their pay. So increasing their pay increases the cost of production for employers, shifting the short-run aggregate supply curve leftward. Do you understand? So as soon as the short-run aggregate supply shifts leftward, then it will come back to this. It will come back to the trend of growth of rates. Is it clear?
Yeah.
So the point I'm making is this: look, to come back to this is a positive output gap. This is the positive output gap, right? Yes. So to fill in this position, the long-run aggregate supply curve will shift towards this side. This will become LRAS1 and this will be LRAS2. That will fill up the position. Another way is to reduce aggregate demand. To reduce aggregate demand, recession has to occur in the economy. And for recession to occur, the central bank has to increase the interest rate. An increase in interest rate increases the cost for borrowing. So that would reduce demand for goods. So demand pull inflation would reduce. That will shift aggregate demand left from AD1, from AD2, this is AD2, SRS2, from AD2 to AD1. That makes it to go back to the trend level. Yes or no?
Yeah.
That's the second point. The third one is that as soon as government tries to reduce this, if it doesn't solve, if aggregate demand does not stop reducing, inflation continues to rise over time. Workers will demand for higher wages. As soon as workers demand for higher wages, it will shift the supply curve leftward because the cost of production would rise. And if the cost of production rises, the short-run aggregate supply curve will shift upward or leftward from SRAS to SRAS1. And that will mean that the economy will go back to its trend level. That is how to solve it. So we can solve it by increasing our long-run aggregate supply, reducing the aggregate demand, or reducing the short-run aggregate supply. I think positive output gap is clear. Any question about that?
No.
Good. So we'll go to negative now. Be right back, please.
Okay.
So we'll go to negative output gap. So for negative output gap, it simply means that the economy is operating below its trend level of growth. So since it means that the economy is operating below the trend level, it can be graphically represented below. So for the trend level, it simply means, look, based on the graph, you have the graph, right? Okay. You can have this. So the economy, the equilibrium level is at Y2, 0Y2, but the economy is operating at 0Y1, where the short-run aggregate supply and short-run aggregate supply and aggregate demand is intersecting. So that means the economy is operating below its full potential. So that is the point there.
Negative output.
That's what we call negative output. I think it's clear. Okay. So the negative output here is Y1, Y2. So we have a negative output between Y1, Y2. So the line between Y1 and Y2 is what we call negative output. So it's a gap. How do we close this gap? Because we can't leave, if we leave it out, if the economy is operating to negative output, you bring about deflation. And it simply means that there are waste resources because the economy is not operating at full capacity. So that's unemployed resources. So it needs to be solved by closing the gap. So how do we close the gap? The aggregate demand needs to be boosted through government policies. So this situation needs to be solved with government policy because most of the time it's a very large situation. So to solve it, we need government intervention. Do you understand? So government will come up with what? Policies that will boost the aggregate demand. So maybe government could come up with fiscal policy, supply side or fiscal policy, which is reducing taxation or increasing subsidy. So either reducing taxation or increasing subsidy, both of them will lead to an increase in aggregate demand. So as soon as aggregate demand increases, it means the aggregate demand will shift rightward towards the long-run aggregate supply curve.
Okay.
You get it, right? So that's on demand side. Demand side there is government will try to find a way to increase aggregate demand. And if government is able to increase aggregate demand, the aggregate demand curve will shift rightward from AD AD1 to AD2.
True, yeah.
So that would fill up the gap. And if it's about the short-term aggregate supply, government can come up with supply-side policies, or government can even use subsidy to ensure that the short-term aggregate supply curve also shifts towards the long-run aggregate supply. I think it's clear.
Okay.
So that ends positive and negative output gaps. So the next class we're going to talk about difficulties in measuring output gap and the rest.
Stairs.
Hysteresis, yeah. Take care.
Yeah.